Welcome, everyone. As people drift back in from coffee, I'm going to actually ask my panelists to make their way to their chairs, so we have them on stage now, just as they're making their way on, he says. It's great to be here. For those, I see a lot of familiar faces in the audience, but just to introduce myself briefly as the moderator of this panel. My name is Hugh Whelan. I'm the managing editor and co-founder of Responsible Investor, and we are a global news website for institutional investors on ESG and sustainable finance. I've been a finance journalist for 20 plus years, now focusing exclusively on sustainability in the institutional investment area. We've got a brilliant panel to talk about UNEP FI's excellent positive impact initiative. Just to give a very, very brief recap on what's happened with the Positive Impact Initiative in the last, I guess, the last 12 months, a bit longer, maybe a couple of years, really. We have seen, and we had some mention of the positive impact work yesterday by Ligia Nourlil, director of the UN's Environment Economy Division. She was talking about the outlines of the project, and to take a step back, 2015 we had the launch of the Positive Impact Manifesto, followed in 2017 by the Principles for Positive Impact, and this latest set of initiatives are very much building on those principles, followed this year by the Rethinking Impact to Finance the SDGs, which is the sort of context for the PI model frameworks and the PI impact radar, which are being launched at this event, to talk to us about exactly what they are and how they fit within the context of the Positive Impact Manifesto. We have Karine Ab. Karine is the program lead for the PI initiative at UNEP FI, and she's going to take the podium to introduce the latest launches of the project. And then I'll introduce our panelists, and we'll get into the heat of discussion around what impact is, how it's being measured and looked at in the context of the finance industry, of which we have a great variety of representatives here. Karine, over to you. Thank you.
Thank you very much, Hugh, and it's a pleasure to have you with us. You've been following Positive Impact for a couple of years, as you say, and thank you to everyone for choosing this session. Just to indeed link back to yesterday's plenary, which some of you might have attended, Rethinking Impact to Finance the SDGs. What we're setting out with the Positive Impact Initiative is really a proposition to contribute to the debate and the agenda on financing sustainable development in the context of the SDGs, with the idea that impacts, and in particular positive impacts, can actually be a source of revenue generation, and that this could be unlocking that potential for revenue generation is a key part of addressing the financing gap, particularly where it's most needed in developing countries and in Africa. What we did say yesterday, if you'll remember, is at the root of whatever we try to do to achieve positive impact, whether it's indeed unlocking some of these new impact-based business models, or whether it's making current business models more impactful, impact does remain the common language and the common ingredients through which indeed we can make the economy more impactful and with which we can go to new types of business model. So that really means that what we need is a move to better understanding of impacts. So it's a capacity basically to undertake impact analysis and to do so in a holistic way. And just to go back to what Hugh was mentioning of what we launched last year, which were the Principles for Positive Impact Finance. Effectively, that was a high-level framework, or that is a high-level framework that lay out that indeed we need to have a holistic approach to understanding impacts. The principles basically focus on understanding, well, if we're trying to make finance more sustainable, then what is sustainable finance? It's what it is that you finance, right? So what is the nature of what you finance? How do you define that it would be positive impact? And that is, the focus of those principles is to provide that definition of what constitutes a financing that can be considered positive impact. And it's laid out at a very high level to say that positive impact finance is that which serves to finance something that will have a positive contribution to one or several of the 3 pillars of sustainable development, provided that any negative impacts have been duly addressed. and then it's requiring that effectively we have in place the processes, the frameworks that are needed to do that, and that we are transparent both on the processes and the outcomes that are laid out. And so that is really the basis on which today we're very proud effectively to be launching a series of tools that will help us take this very high-level framework of what it is that constitutes sustainable finance and put it into practice. And so what we're launching today, after a long process of work with the members of the Positive Impact Initiative and with a large number of stakeholders, is two sets of guidance. So on the one hand, you effectively have what you see the trio there on the screen. I've got two in print here that you might have seen outside, is a set of frameworks. So these frameworks are effectively about the processes and the nature and the steps of the analysis that you would undertake for different situations. So we've started here with a couple of types of investments and products. I'll talk a little bit more about that in a minute. And on the other hand, we have the impact radar, which is the other document you'll find outside, which is more about, when we're talking about holistic vision of impacts, what impacts are we talking about? The SDGs provide a very, very powerful policy framework and backdrop of what our objectives are, but how do we translate that into business, and how do we translate that into impacts? The SDGs are a mix, effectively, of targets, of impacts, and we need to unify that into an impact language if what we're seeking is implementation in day-to-day financing. And so that's what the radar effectively is about. I'll just take a few more minutes to walk you through what's inside. So if we look at the model frameworks, effectively, as I was saying, this focuses on the processes of the analysis that you would undertake in different situations. The scope of the frameworks that we've developed, I'd like to take a minute to explain about that. Effectively, when we're looking at a series of financing or financial products, we thought it was important to differentiate between what could be seen as the primary level of originated products and then secondary financial products that might come on top, such as effectively index-linked products, funds, etc. So what we've done in the first instance, we've started with the primary level, and within that, we've distinguished effectively financial products or financings where the use of funds will be effectively known, as will be the case, for instance, for project finance, but not only, and cases where it is not known. Typically, a general purpose corporate loan would be one example. And so the two frameworks that you have available in print here, and the third framework, are effectively one on unspecified use of funds for corporates, which is obviously a very big part of the economy and relevant both to banks and to investors in a very central way. And secondly, on specified use of funds, you will find one that focuses on project finance, and we've decided for that one to focus specifically on equator principles scope, for the simple reason that this is a well-established standard that people already have in place and will be able to build on very easily. That is, in fact, a common feature across the frameworks, has been to build effectively on existing standards and tools and not reinvent the parts of the analyses and the tools for analyses that already exist. So that's in terms of the scope at the moment of the frameworks that are available. I'd like to say a few words now about the target audience for these frameworks. Obviously, it's financial institutions, but I think it's important to specify that these frameworks have been designed to be relevant both to a banking audience and an investment audience. As you heard yesterday in the plenary, when Nino dos Santos was mentioning about the whole value chain being on the stage, that is a very central component to what we're doing under the Positive Impact Initiative, where we think that connection between the banking community and the investment community is a central part to resolving some of the conundrum around SDG finance. That is not the only target audience, however, for these frameworks. It's also effectively for third parties in a large sense, but perhaps in a very pragmatic sense for the financial institutions represented here and who are obviously delivering financing and structuring products. It's intended, for instance, for analysts, for those providing second-party opinions, verification, with something like the positive impact principles. As mentioned, we had a very high-level framework, would not necessarily be easy for a third party to exactly determine whether indeed a product or a financing was positive impact as per the principles. With these frameworks now in place, there should be the necessary information to be able to make those qualifications. So that's in terms of target audience. In terms of the contents, what's inside these model frameworks? They've effectively sought to tease out what the analysis looks like in three main parts. That's really the core part of the frameworks, is to look at, so in terms of the holistic impact analysis, what does that, effectively boil down to? And the three parts are identification, evaluation, and monitoring. And so in each of these instances, we've specified the specific purpose of that stage. We've then proceeded to give possible approaches that can be undertaken, and then what the outcomes of that stage would be. So that is detailed effectively in the contents. One point that's very important to note at this stage, what you have in these frameworks, I like to say often, is effectively a bridge in a way. Because the economy that we have today and the companies, the projects, we might not have, or we know we don't have, all the impact data that we need. However, we know that we need to go increasing understanding of impact, and that is the foundation for better impact management and also new business models. However, not having the data doesn't mean nothing can be done, and we have a number of proxies or a number of projections, and so you'll find in these frameworks that we acknowledge some of the limitations and offer effectively a review of a range of solutions that approach themselves to impact and are, suggested for use in a way that you are effectively going as far as you can in each instance. And because of the requirement for transparency, that you're indeed moving the needle increasingly up and being able to engage also with clients for an increasing amount of information on impact. So that's just an important point. And we do need to build that bridge between where we are today and where we want to go, which is an understanding of impacts and availability of information on impacts throughout. The other things you'll find that are covered in the impact frameworks are effectively information on transparency, on third-party opinions, and a few other considerations. But I'll move on just very quickly to the radar, and so we can get back to the panel, which is the most important part. The impact radar, as mentioned, is the translation exercise, basically, of how do you go from something that's macroeconomic to something that you can bring back to impacts and that will be usable at an implementation stage. So what you have there is a wheel that effectively tries to identify, what would be the main impact areas that would enable you to say that, okay, I have a holistic view effectively of, the social, the economic, and the environmental dimensions of sustainable development. It's referenced in the framework documents so that it's evidenced, how this radar might be used for different situations. It's not the same depending on whether we're looking at a corporate, project finance, others. The exact moment and way in which it might be used are different. It's not something that is compulsory or unique. This is something that is meant to help and to act as a prop, either for those who do not have a referential of impacts already established, or if you want to, cross-check it, because we've gone quite far effectively in trying to cover the full gamut of areas where one might have a positive or a negative impact, which is what, consistently throughout the frameworks, we're inviting people to look at through identification, evaluation, monitoring stages. So that is effectively the tools that are out. We're very, very pleased to be able to present them to you today and hope that many of you will test them and try them, but more will be said about that in a minute. And hand back over to you, Hugh.
Great, thanks, Corinne. I guess people can go onto the UNEP FI website and take a look and test out those tools. We're going to go over to our panel discussion now. Impact has undoubtedly become the buzzword of the last 12 months, I would say. So we're going to try and get underneath what impact means for a series of financial institutions. We've got two banks, one asset manager, one asset owner, asset manager association. I'll introduce them very briefly now. In the center, we have Denis Shield, or Denis Childs, actually, as we should better say. Denis heads up the positive impact finance work at Société Générale. It's great to have Denis here. On the far right-hand side, we have Ghizlaine Nourlil, Sustainable Finance Manager at BMCE Bank. I hope the pronunciation was even vaguely good. Ghizlaine, thank you very much. From Morocco, it's great to have the perspective of a Moroccan bank on what we're talking about here. Next to Ghizlaine, we have Andrew Parry, co-chair of the PI Initiative and head of sustainable investing at Hermes, London-based fund manager that will be well known to many. And next to me, we have Will Martindale, Director of Policy and Research at the Principles for Responsible Investment, which, of course, is the association on ESG integration for asset owners and asset managers globally. We are going to effectively ask, first of all, each of our panelists to tell us what impact means to them in their thinking and strategy and business implications as an organization. We're going to start with Denis. Over to you to talk to us about where you're at with thinking around impact at Société Générale. Denis.
Let's say banks are very pessimistic compared to asset managers. Banks used to look to the negative impacts only and how to cope with the negative impacts they were having indirectly with what their clients were doing. Whether asset managements, of course, were not selecting the bad things, they were selecting the good things. So impacts now, for us, we started to say, okay, but our clients are not only doing negative things, they have lots of positives. So impacts is both positive and negative first, which was not so clear in the banking business. The next is, in order to assess impacts, you need to know where to find it. So, for instance, we are using a kind of the impact radar in order to identify what impacts might be the impacts that this or the other client are meeting. We could have more sophisticated, defined by sectors, defined by geographies, and that's what we're using. Then, when you look to the positive side, when you can prove that the negative side has been assessed, it opens businesses. I mean, for instance, in our bank, it created a good way to go for green bonds or for positive impact bonds. Then, when the market developed in green loans and impact loans, we also developed an approach to clients to sell them that if they were correctly securing their negative impacts, we could put in the light their positive impacts. But let's say we are going through a new step, which is to say, okay, now we are rather looking into impacts as extra financial. Why not looking at impacts as the purpose of our clients? I mean, not to have a nice to have, like would be the positive impacts, but necessary to have to get markets. That's where we started, and maybe Ghizlaine will talk a bit about it, but we started in Morocco to look to start the discussion with the government, or rather with the region of Casablanca, saying, okay, what you like as impacts, and could we draw a solution back from the impact you're looking for, and that some company would be committed and be remunerated on the impact. The more impact, the more income. And that's quite new. So that's what we call impact-based finance, and we develop a full team in Société Générale to develop this new approach. That's what impact is for us.
Just elaborate a little bit there on the nitty-gritty of your business as a bank. How does this actually translate into real loans business to companies that you deal with? Real economic activity? Just for those who may be a little bit, I don't understand. Why? What has this got to do with real banking?
Well, real banking is to be close to the clients. So in fact, some of our clients are meeting an issue, which is their profitability is declining on their original business model. Then should they switch to other business model? Yesterday was on the scene Nokia. Nokia had to reinvent themselves, and Nokia is quite a telecom and IT company. But their move is to bring solutions to their clients and what they call end-to-end type of approach. In fact, you could call it from B2B to B2C. But this is not very simple. This is a different business model. And how much they go in the C, in the B to B2C, which is a question for Nokia. So we are entered in discussion with Nokia to take some cases and see how they could reach new markets and which would bring new type of finance. So today, this is an emerging business. So we are still rather on a research and development mode in SocGen. Of course, let's say the normal course of business is our normal course. It's the mainstream today in SocGen. So that's why on the one side, we are taking advantage of the existing business model to develop products, like I said, green bonds, green loans, impact loans. And on the other side, we are co-constructing with some of our clients, discussing with the strategy department, with the marketing department, what new market they could let's say, address, provided that they would get a new kind of finance that we backed by impacts.
Okay, let's we'll come back on some of those points, Denis, afterwards. But I want to bring in Andrew to talk about the asset management side of things. Denis made some interesting points there about changing business models. Andrew, what does this positive impact initiative mean to you as an asset manager? How might you use it? How do you use it already? And how does the thinking translate into the job of picking companies that are going to deliver for your clients?
Well, it fits very neatly with our sort of business model and business imperative. We've always put holistic returns at the center of what we do as part of taking our broader responsibilities as an asset manager seriously. So, you know, our responsibilities do go beyond just producing attractive risk-adjusted returns to actually help support a more resilient and equitable system, because without that, the long-term viability of many companies, their profits, their share prices just is undermined. So we just see this in sort of the broader, wider context. Denis mentioned that as a banker, he tends to be pessimistic, or that's been the history. As a stock picker, you have to be an optimist. You know, you don't go into things picking companies thinking they're going to fail. So for me, actually, the move into impact investing really was a way of identifying some of the most exciting growth opportunities out there. It was a framework for thinking about not yesterday's growth stories as represented by the index, but by these exciting, emerging, nascent industries. You know, the world's in a series of transitions. You know, technology is changing the way that we live our lives, the way that we work. The climate is beginning to impact on many businesses. Demographics are changing the way that companies will think about employing people. So we're in a whole series of turmoils and change. And so we do need to have this very forward-looking view. And the great thing about impact, say, as opposed to ESG, is it has this forward-looking element to it. So it's about identifying emerging trends. So you think about the SDGs, you know, which are universal. They represent sort of ways of tackling some of the most pressing problems in the global society. There's around, you know, it's estimated $93 trillion of expenditure over 15 years to meet them, half of which is incremental, probably more because we're running slightly behind. Now, if you're a stock picker, you go, wow, $93 trillion, that's a lot of top-line growth for innovative companies who have these adaptive, forward-looking business models to see these underserved needs as a great opportunity for future growth, to recognize that they are a way of building great resilience into their business. So for me, you know, this was just a natural evolution of what good stock picking should be about. It's about referencing the future rather than referencing the past. You know, it goes beyond ESG, which is still very important. It's still essential in understanding the risks and processes of a company. But if you actually want a good definition of the difference between ESG and impact, steal from a friend of mine, Mark Campanelli, who said, ESG is what keeps you up at night. Impact is what gets you up in the morning. So for me, coming to it, it is about that excitement of actually realizing what we're supposed to be doing is finding these future returns. And it's a great way of shining a bright light on the world and the new opportunities out there.
Is that actually the way that portfolio managers work, though? I mean, usually they're very focused on the here, now, the investment returns they're going to make in the next 1 to 3 years. I mean, they're not spending that much time, are they, projecting forward 5 years on where the SDGs might take portfolio companies?
Well, it's not just where the SDGs, you know, there's plenty of other, you know, trends and changes which are allied to it. The SDGs give them a good opportunity for reframing their thinking. You know, they weren't designed as a tool for people like me as an investment managers, probably weren't even designed as tools for bankers. But you can see them as an opportunity for defining these opportunities. Now, I would say that good investment managers actually have always looked beyond the short term. You know, the short term's a very crowded place. You know, there's a statistic that 90% of the turnover on Wall Street at the moment is driven by quantitative, passive, and algorithmic trading. So anybody competing at the short term is competing in a very, very competitive landscape. So I always view that time is the last true arbitrage. If you can extend your time horizon beyond the short term to the longer term, extend it to the time where a period that's associated with how companies are allocating capital, I think you will win in the long term. There's great evidence from people like FCLT and lots of other people that both investors and companies who take a longer term view on the way they manage their assets actually end up with more sustainable and better returns.
Okay, well, there's a few things we can come back in on afterwards, but I'd like to bring in Ghizlaine to talk about the usage, the thinking around impact as a bank on the ground in a country like Morocco, what the reality of that is. Over to you to talk about the work you've been doing.
So as you know, the investment needed in Africa are so huge and important. So Africa needs investment on infrastructure such as transport, education, sanitation, healthcare, security, and other sectors. So combining economic development and ENS consideration, we can achieve SDGs by investing in catalyzing less public funding and mobilizing more private funding to invest in these projects. So Africa needs more and more investments. And how to do it? That is the big and complicated question. So the answer is attracting more and valuable business valuable projects, impact-based. So as an African commercial bank, we believe that thinking impact is the key to improve people's lives. So we started the journey by implementing the environmental and social management system in the bank based on IFC's performance standards to avoid negative impacts and to collaborate with clients to mitigate their negative impact. But it was difficult in the context of African country and emerging market when the requested ENS consideration are not, there is not a binding regulatory framework. It's not obligatory for all the banks, and it was very, very difficult. So to convince clients to collaborate with us in order to set up an action plan to mitigate ENS action. So the solution was to provide products, was to provide loans. So we started with what we call the Moroccan Sustainable Energy Financing Facility. It is a program in partnership with the EBRD, IFD, EIB, and KfW in order to finance energy efficiency and small-scale projects on renewable energy. So what is interesting in this product is that we defined at the beginning the KPIs to achieve. It's about 20% of energy efficiency and 20% of green gas emission. But what was missing is the social component and the monitoring after the implementation of the projects and the investments. But what was interesting in the approach with EBRD, with the support of the European Union, is that the client there was an awareness of the clients, and we raised awareness of these considerations, and the clients received 10% of the total amount as a cashback when he implements the action plan. And the CO2 reduction was sold in the credit carbon market. So this case justifies that considering positive impact is a source of revenues for our clients and as well for the bank. Because as we consider this reduction of this 10% of cash as a cashback and reduction of CO2 in our financial structuring and analysis. So after that, by joining the positive impact initiatives, we believe that the framework is something which gives us an overview, a holistic overview, and holistic approach to consider negative and positive impacts, and how to help our clients to improve their investments and to attract more revenues. So in the second product we launched, which is about water treatment, we integrate the positive impact approach from the beginning, and we integrate positive impact principles. So we defined what are the KPIs that we want to achieve through the investment. For example, for a water plant, the client can reuse the water which is treated, and also give an opportunity to the community to use the water treated on the irrigation and the agriculture field, and also to collaborate with the utility operator to have to reuse the water and to have a low price for the new one, and to open the industry for students who want to do some researches about water quality and agribusiness. So it's really an amazing experience, and using the positive impact framework for us is the beginning of an amazing journey. We are launching as well another products. We have a specific context as a commercial bank. We are in the retail. We use loans and products. We launched as well a green bond in Morocco. It was the first green bond in Morocco. But we are looking to launch an SDG bond, which will be based on a positive impact framework.
Great, thank you very much for that. We'll come back to a few extra points after we brought in Will to talk about how investors are responding to initiatives like the impact investing framework from UNEP, but more broadly actually about the question of impact and what it means to them and how they can think about it as investors with duties to obviously to get financial returns for their members. Over to you, Will.
Great, thank you, Hugh. I think that we're starting to see 3 generations of responsible investment. And so the first generation, I think we could categorize as awareness, and this is probably 1990s, 2000s, where investors begun to understand that non-traditional factors, I mean, still financially material, but perhaps non-traditional factors are relevant for how they manage their investment processes. So the first generation is around awareness. The second generation is around integration. And PRI has been part of that, the idea that investors systematically integrate ESG issues as part of how they undertake investment analysis and make investment decisions. And this has been ably supported, at least in some markets, by policymakers. But I think what's exciting, and this is where the positive impact principles and framework and the radar and other tools are so important, is that we're entering a third generation. And that third generation is impact. Less how do ESG issues affect my investment decision, and more how does my investment decision affect ESG issues. And I think there are 3 ways in which investors can contribute to impact. The first is that they can allocate to more sustainable companies. And actually there's 2 parts to that. One is companies that have a more sustainable footprint, and the other is companies that develop products that help us manage the energy and sustainability transition. The second way that investors can contribute is through engagement. They own companies and they can use their ownership rights in order to make those companies more sustainable. And then the third way is around the frameworks within which investors operate. This is actually my personal part of the job that I do at PRI. And that's looking at how we can create investment frameworks through regulation and normative frameworks and other tools that really help investors understand and incorporate impact in how they go about their investment.
Well, are you seeing any regulatory moves there that would actually oblige investors to be reporting more about the impacts of their investments, which is what you suggested earlier?
So we're starting to, but it's fair to say that it's very early. Regulation has tended to be around processes. It's make sure that you have a process in place to consider financially material factors and that you disclose that process. There's not yet much regulation which says, and therefore what is the impact of that investment decision, and disclose that. But there are a couple of examples that we can point to where this is starting to be incorporated by regulators. We're in France, so perhaps first mention Article 173, where investors must disclose their emissions against their portfolios, but also manage that against an energy transition. There's an outcome there that they must consider. There's similar regulation in California. It's called SB 100, and it tracks quite closely the ethos and principles that underline Article 173. And perhaps one final example from my own country, the UK, the Stewardship Code, which has been incredibly important in helping investors understand that second part of impact, that active ownership, how they engage with companies. The owners of the Stewardship Code, the Financial Reporting Council, are beginning a consultation with investors, and part of that is asking investors how they consider impact as part of their stewardship activities.
Great, thanks for that, Will. Just before, we're going to open it up for questions, so if you have one, stick your hand up and we'll try desperately to figure out who's got their hand up with the lights on. But just before we do, Corinne, I wonder if you might point to a couple of examples of people that you know that are using the framework in a what you would deem to be interesting, shifting towards sort of best practice approach if there is one, or that might be going too far at the moment, but you know, members that are really starting to take practical steps to use these tools to actually drive their own internal business changes and lead to new businesses being created, which is your ultimate goal.
Yes, absolutely. Thanks, Hugh. I think you've definitely got a few on your panel right here who would give those examples. But indeed, within the still small and intimate community of the positive impact membership, we do have very interesting experiments going on, from South Africa to Greece to Canada, and you know, I think what's important is that this is actually really just the starting point. It's taken us, as you've seen, a little while to get from the principles to this further guidance on how to go about things. I think we've seen and tried to get to grips with some of the difficulties and some of the challenges of trying to bring strands which were already there in terms of understanding negative impacts, understanding positive impacts, looking, you know, being interested in reporting on the one hand, on product development, on risk management, how to basically bring those different components together in something that's more holistic and that will have that, you know, that future outlook of, you know, going with an economy that is more impactful, but, you know, actually going into impact-based. And, you know, that has been really quite a long process for us to get to, indeed, these first frameworks, and there are additional ones needed. We've covered, you know, just a couple. And I think at this point, it's actually a great opportunity for us to reach out and really make an open call beyond the little community that has kickstarted this, and even beyond UNEP FI, but really, you know, to PRI and to many other networks. I'm thinking of the Impact Management Project, I'm thinking of UN Global Compact, the UNDP's new endeavor also brings very important actors to the table. And, you know, I think this is really now an open invitation to take these, which are, you know, a little bit of a V0, a version 0 and a starting point, and to test them, to try them out in different ways, either to, you know, to a portfolio, to issue a new product. We've heard a few examples that are coming out. And, you know, come back to us and liaise also with the members of Positive Impact to develop it.
Okay, that seems like a good place to take some questions. Stick your hands up if you do, otherwise you'll have to listen to my questions, which are incredibly dull and boring. So if you have better questions, no one, we do, we have one at the back. Whenever there's one, there's usually 5. If anyone else has a question, stick your hands up now, we'll get them answered as quickly as possible by our panelists. Name, organization, and question, please.
Hi, Jane Wilkinson from the Luxembourg Stock Exchange. I'm wondering, what do you see the parallels between the positive impact framework and the work of the EU on the taxonomy, new taxonomy?
Let's take Will firstly, and maybe Andrew. Any thoughts there? Denis, actually, let's do a triumvirate. Will first.
Okay, thank you. So just for those that aren't familiar, the EU has made 4 regulatory proposals earlier in the year. The 3 that are currently working their way through the political process are around clarifying that sustainability should be part of investor duties, codifying sustainability issues through a taxonomy, and in particular it's the sustainability of economic activities. And then 3rd is around benchmarks and introducing regulatory-backed benchmarks that are both in line with the Paris Climate Agreement and also a positive contribution towards the Paris Climate Agreement. And actually they're using the positive terminology that UNEP have so ably taken forward. I think that there are many other initiatives that can be put on the table that we could consider here alongside the EU's process. I think that's because we're moving to an environment where we're requiring more technical expertise, there's much more scrutiny, and we're having to scale up the work that we're doing. And with that comes some consolidation, and hopefully with that comes impact and outcomes that we're trying to achieve. The bit that's interesting with the taxonomy is going to help to define economic activities that are considered sustainable, is going to be a reference point for investors, and it's going to incorporate some of the underlying principles within positive impact, such as consider positive impact, but then you need to also consider the negative impacts as well, and if the overall application is positive, then it would be considered as part of the taxonomy. So I think it's extremely a contributing factor and very much part of the overall positive impact story.
Okay, Andrew and Denis. Andrew, any thoughts there?
Well, just very quickly, I think there's a lot of new taxonomies, new methodologies arising. They're all quite context-based, so each of them is subtly different. I don't think they have to be mutually exclusive. Like Corinne was talking about, that we are very happy to work in partnership with all agencies, the EU, PRI, etc., because I think there is a power in that collective voice. I think really what it does illustrate is the enthusiasm for really having much more standardization and definition behind the notion of sustainability. I think everybody recognizes it's an imperative, but it is a bit confusing for many investors. It's very confusing for many companies when they're trying to report on sustainability characteristics because there are so many standards. So I think there is a welcome move towards people working much more in collaboration and a move towards standardizing both the definitions and the underlying information.
Andrew, are we getting a bit carried away here? Everyone's talking about impact reporting now. We used to talk about sustainability reporting. Why are we changing terminology here?
Nice word. It's a nice word.
Is that enough? We need action now, not nice words.
No,
so
you're right. But people pick up on words, and words are really important. They're the way that we communicate ideas and instill action and inspire people to change. So let's not knock words. They have a very important role to play. I think we know that even sustainable reporting is in a nascent phase. So as we begin to evolve and adapt the language, Will talked about outputs and outcomes, which is really is a massive shift in the way that we report and how companies report. So rather than just focusing on inputs and processes, I think this is what the language of sustainability and impact, which can be interchangeable after all. Will has a different definition of impact to me, potentially, but that's great because it makes a market. So I think if we have a focus on actually what's coming out at the end of the process, what is actually changing, and what problems we're actually solving, that's got to be a good thing. Whether you slap an impact label on it or a sustainability label, at the end of the day, I'm not too fussed.
Do you think there's business in this for asset managers in the retail area and other fields that clients want to see this information as well? I mean, otherwise it's a kind of obligation on you, isn't it, to demonstrate you're doing something good? That usually costs money, but...
Well, if you're forced to do something, you'll never do it well. No, I think investors see that there's some two angles. One, as I mentioned earlier, they're wider responsibilities. In a world of polarized political views, I think many companies and investors see that they need to play their role in creating a more sustainable, more equitable, resilient system. Also, as I mentioned earlier, as asset manager, whatever I do, I have to do it as a lens to actually be better than the competition, better than the index, to generate better risk-adjusted returns over the long term. So for me, it's not just about a convenient labeling exercise. It's actually about making me better, my colleagues better at their job, because at the end of the day, that is going to be the way that people test us. If we do this and we underperform consistently, that's not a successful outcome.
Can we get a mic to the gent over there on the left? If you keep your hand up, we'll get a microphone to you. Denis, do you want to just chip in on the last question, and then we'll take the final question, and we'll try and bring everyone in at the end.
Just what was interesting is that the job EU is trying to tackle is to have a convergence in taxonomies. So that's key. But then taxonomies is a proxy to impacts. And what was very interesting is that they took this definition, the exact same definition we are taking for positive impact. EU took this definition. When we started the job back in 2014, people were complaining why, just what you said, what is impact new to sustainability and so on. But then this concept is the exact concept where you have clarity, you have what is a real result of your action, and we need to progress on impacts. Then when we designed the frameworks, when we designed the radar, of course, this was a job that was performed by our members, but if you look in the details of what we've produced, you will see many references, I don't know, to IFC, to World Bank, to UN, to what we want to do is not to reinvent the wheel. What we want to do is to contribute, to have the same language so that stakeholders can understand what's going on in the economy. So basically, we want to have a role to help the other initiatives, to take the best of the other initiative, and that everyone is not in a silo. The first move was to have banks and asset manager together, which is not so usual.
True. Okay, last question, if we can, and then we'll try and bring in each of the panelists to wrap up.
Sure. Good day, thanks everybody. I'm Bob Walker from NEI Investments in Vancouver, Canada. I was here in Paris last month for the investor forum of the Global Impact Investor Network. And there's 3 days of pretty wonky conversations about impact measurement, great conversations. I'm just trying to understand the link between this initiative and the GIN.
Okay, the work of the Global Impact Investing Network and this work. How are all these initiatives tying up, I guess, is your question there, Bob. Ghizlaine, do you want to answer that? And then we'll just, last word from each of the panelists on where impact and its measurement is going via the tool. Ghizlaine.
Sure, thank you, and thanks for that question. It's an important point, and it, I think, ties into some of the points that Denis was just making now around the linkages. Indeed, the commonality is that focus on impact. I think what we're trying to do with the Positive Impact Initiative is to try and have an approach to impact that we can use in a widespread way, that we can take mainstream effectively, and one which we can also use to engage with a variety of different stakeholders. So that doesn't mean that we're positioning the initiative or the principles as being anywhere in a hierarchy vis-a-vis any of the initiatives that exist today that are focusing on impacts in general or a specific area of impact, whether environmental or social. But we are trying to provide clarity effectively by having a very high level definition of positive impact, and then producing frameworks which hopefully, as I was saying before, would enable us to effectively have a bridge between the two ends of the spectrum, from extremely targeted, very well measured, very purposeful and very driven investments as we have in impact investing, to the other end of the spectrum where we have very little awareness of impact and trying to get across that. And as said, what we're doing now in this phase, now that we have these tools, is to work with each of these networks to see how we can engage all of the communities and make this a common good and a common next step.
Great, thanks for that, Corinne. We are going to have to wrap up there, but our panelists will be around if you want to talk to them about the initiative or their views on where impact measurement is going to. I'd like to thank them all for their interventions and thank you for your questions. And we will hand back to our presenter now. Thanks to our panelists. If we could, appreciation in the usual way. Thank you. Thanks.